Hi there, it's the Baird again. We're going to get into CPA number 5, alternative investments, and ask the questions, are any of these asset classes and investments any good? We're going to be studying three of the what are called alternative investments, and there are others out there, but the main three that are out there are real estate, commodities, and hedge funds. So let's explore real estate first. Real estate is certainly a distinct and separate asset class. It has different tax characteristics than stocks and bonds. There are different risks present with real estate. It has a low correlation to stocks, generally speaking, but not a negative correlation in most market environments. It has different return expectations and different historical returns. There are different ways of investing in real estate. One of those is to own your home. Your residential real estate is basically having an interest, as we've discussed in class, in real estate. Most Americans who have exposure to real estate do that through their homes and also through stocks. Actually, 15 of the 500 stocks in the S&P 500 index are actually real estate investment trusts, which we'll talk about. You can also, of course, own an additional home or homes. I have one client who owns 5 homes. Farms, business real estate is very common and the like. And that's where you basically own this yourself in some way. There's no partners or anything like that. Then you can own them indirectly through pooled investment vehicles. These are the private type of that is usually limited liability companies. In some states, you might see limited partnerships. They're usually taxed as a partnership for tax purposes. And then there are real estate investment trusts, where basically a whole bunch of investors get together. It could be hundreds or even thousands of investors, and there are two types of those. One is publicly traded and not publicly traded. There's actually some other types, but we'll focus on these two right now. Most types of investors have some type of real estate allocation in their portfolio, uh, other than just home ownership. Pension plans, both public and private, foundations, endowment plans, insurance companies, as you would expect, a lot of them own real estate in their portfolio. Uh, and Public investment in real estate has grown over the years. Investable real estate as a percentage of the gross domestic product has increased over the last 20 years or so in the United States, Germany, Japan. Also increases, a big increase in China and India as well, and also Brazil. So there's a lot more opportunities to invest in publicly traded real estate investments. The risk and return of real estate is generally characterized as something between fixed income investments, bonds, and stocks. Typically, the standard deviation of real estate as an investment is lower. The returns tend to be lower than stocks, higher than bonds. But as we see, that can really fluctuate from decade to decade or even over very longer periods of time. So again, real assets, real estate, basically that you invest in, generally somewhere between equities and fixed income on the in terms of standard deviation and also in terms of their annualized rate of return. So, in some other countries, real estate has actually done better than just investing in the total stock market of those countries. France, for example, housing investing in housing has over the very long term, 1870 to 2015, has actually produced better returns than investing in stocks. Uh, then you go all the way down to the United States and you see housing as a form of real estate investment, 6% average annualized rate of return versus 8.4% for equities or stocks over this very, very long period. Uh, Since 1950, equities have performed real estate if we look at an average of 16 countries and look at the geometric returns. You'll see that housing, which is basically the sample of real estate that's being looked at here, has rental income, and it also has capital gain, basically the appreciation in the price, yielding a total return in this full sample of 11.75%. That's pretty impressive. Equity or stocks have capital gain and dividend income. Capital gain is the increase in the share price over time, 8.75% uh, over this time period. That's the full sample, but if we look at after 1950, what we see is housing has a 12.94% total return, and the total return for stocks is about 10.32. So that actually looks like real estate is doing better, but that's across 16 countries, by the way. That's not just looking at the United States. Most of the returns from real estate come from rents received. I have one of my clients invested in basically vacant land 30, 40 years ago, and uh, land that has been turned into residential lots and has been sold slowly over time. Those vacant lots really haven't done very well, even though they've been in an area of Florida that has boomed in terms of its investments. Uh, if you look at the rate of return on those lots, because you're paying taxes every year, you have to get the property mowed every now and then, and the like. If you look at the rate of return on that compared to the rate of return on stocks over that time period, there's really very no comparison. So if you are going to invest in real estate as an investment, uh, because most of the returns come from the rents received, you definitely want to have an income producing property. Real estate investment trusts are a form of investing in real estate. Basically, you can invest in shares by putting your cash into REITs, real estate investment trust. You receive distributions from them every year. They use that cash with all the other investors' cash to go out and buy basically anything from shopping centers to office complexes to nursing homes to hospitals to office complexes, big skyscraper buildings, all kinds of different real estate investments, and those investments, of course, turn return real estate to that. Here's just a little sample of some of the many real estate investment trusts out there. There's over 1,000 real estate investment trusts out there that you can invest in. If we break that down by sector, we see retail 16.67%, residential, which would be apartments, for example, 14.24%, infrastructure, healthcare, offices, data centers, industrial diversified, broadly diversified, and then lodging and resort properties. Self storage is actually a pretty big thing, and then some other sectors as well. What makes a REIT different? Well, from a tax standpoint, and this is important, is 75% of the assets must be invested in real estate properties or mortgages or other REIT shares. Also included in that is government securities and cash. The reason being sometimes a REIT will raise money and not be able to deploy that immediately. So basically, you have to invest in real estate and mortgages, although you can hold cash until it's deployed and the like. 75% of the revenue must come from rents or mortgage payments, the interest income from mortgage payments, or gains. If you are running a REIT and you sell a property, it's gone up in value, you're going to have a capital gain on that. So those are basically the tax rules for that. All right. An additional 20% of the gross income must be from the above listed sources or other forms of income, such as dividends and interest from non real estate investment sources like bank deposit interest and the like. Right? And no more than 5% of the REIT's income must come from like service fees or some not investment in anything that's not related to real estate. Here's just a look at a real estate investment trust perspectives. This is the Choice Properties REIT. This is a 2018 prospectus. This is actually a real estate investment trust out of Canada. They were raising $2 billion at the time. Some of that could come from basically loans to the REIT, debt securities, and others would be units of ownership in the REIT. Choice Investment Choice Properties Real Estate Investment Trust, made from time to time during the 25 months that this prospectus is open, all right, issue units of the REIT and also debt securities as well. And basically, this just goes and says what is the form of a REIT? It's actually a trust agreement. And this REIT has already been operating. It owns real estate. It owns 547 properties, commercial properties all around Canada and the like. And the laws of Canada relating to the REITs are very similar to the laws here in the United States. The beneficial interests of the REITs are basically divided into units, so you invest in units. And this REIT had 94 million units outstanding at the time that this prospectus was written. And this is just showing that the REITs have issued in the past a whole bunch of units, and it shows what the price per unit was at the time it was issued. So this REIT has been raising raising cash fairly consistently over time. And here's an annual report for Choice Properties from 2019, and we see a couple things here. The number of investment properties actually fell a little bit from 2018 to 2019, from 753 to 756. The occupancy rate was really high, 97.7%. The total assets of the REIT were $15 billion because everything on the financial statements is shown in thousands. The total liabilities is over $12 billion. It's very common for REITs to basically leverage the investors' investments to try to boost the returns. Basically, you go out and you issue debt securities or you get loans from banks, and they have a lot of debt to do that with. They have a lot of rental revenue. They had a net income in 2018, but they had a net loss in 2019. And that may have come because of the sales of some real estate. Perhaps they had losses on that real estate. And then they have what's called FFO. And we'll talk about that in just a minute, but you'll see that the payout ratio was 75% or higher, and the distribution per unit was about 74 cents per share. This is Canadian dollars, but if you think back, and this was trading about $12, $13 a share, you can see that the distribution of cash was let's see, 7.4 divided by 13, somewhere in the neighborhood of about 6% or so. How many REITs are there in the United States? The IRS says there's about 1,100 that actually file tax returns. Only about 220 of those are what we call publicly traded REITs. You can actually invest in non-publicly traded REITs. Those are 880 of those. They're not very liquid and they're very high cost relative to publicly traded REITs on average, and generally you should avoid them. So you have these two different types of REITs, publicly traded and non-traded. Publicly traded REITs can be relatively inexpensive. They have to, when they're publicly traded, they have to file annual reports, and you can sell them on the stock exchange. But non-traded REITs, basically, if you buy into them, in order to get out of them, you have to basically have a buyer for them. So most non-publicly traded REITs once a quarter will take in new investors' money and give it to departing investors. They'll match the sellers and buyers. That assumes, however, that you have buyers for it. And Barry Vindicore basically said, as a rule, non-traded REITs don't perform as well, and investors who buy them don't really understand them very well. Why is that? It's probably a large part because of the upfront fees associated with these. When REITs issue shares, non-publicly traded REITs, they're sold through brokerage firms. It's very common for the commissions on these things to be 10%. So 10% of all the money that's being raised goes to the broker-dealer. In addition to that, you can see marketing support payments paid by the REIT to the broker-dealer firm that helps pay for seminars and things of that nature. Another 2 to 3% in essence. and that really contributes to the to the underperformance of these REITs. But another reason is basically these tend to be smaller REITs, and it's not this, they don't achieve as much economies of scale in terms of their management expenses and the like. And some of them are just quite frankly poorly managed. So if we look at that and we look at these high upfront fees that contribute more than half the shortfall between non-traded REITs and traded reclaims, this is over a certain period of time. 4% for non-traded REITs, 11% for publicly traded REITs in terms of the rate of return. Now, interesting enough, there was an article back around 2011 or so that led to a well-known REIT called Apple REIT, um, that was selling a lot of its shares through a particular brokerage firm in the states of New Jersey and New York. And An article was written about that REIT and the potential problems with that REIT. And the result of that, there was an investigations being held by the SEC and by FINRA, which regulates broker-dealer firms, and both the REITs themselves were fined, as well as David Lerner Associates was fined and also sued by quite a lot of investors. Now, the question is, who wrote this article? I mean, who did all this due diligence? And the answer is yes, the bear did it. I wrote an article about that. Interesting enough, this article was published, and at the time it was published, um, I was on a flight back um, from the West Coast, kind of one of those late flights back from the West Coast. And when I landed, and it was about 1 o'clock in the morning or something like this, and I turned on my cell phone, I had basically messages from three class action attorneys who basically wanted to sue Apple REITs at that point, and the David Lerner firm, and they wanted basically me to testify as an expert witness and the like, which I don't do for other reasons. It's just, but I did write an article that led to David Lerner actually ended up getting barred from the securities industry, as I recall, and uh, the David Lerner firm is still out there as a broker dealer firm. A lot of the brokers left that firm, but there's still a lot there, and they're actually still selling a lot of Apple REITs, which is pretty interesting, even after all that big scandal and all the lawsuits that they had. It just shows that, hey, if you're going to sell non-publicly traded REITs and you're making 10% commission on selling them, it's kind of hard to avoid that, even though it might not be the best investments for your clients. Real estate investment trusts basically have had pretty good performance. I pulled this up very recently from, this is the Dow Jones U.S. Select REIT Index. It's the longest data that I could find for a REIT index. And if you look at the rate of return relative to the stock market over this same period of time, uh, and you basically see that REITs have slightly outperformed that. The growth of wealth, $1 growing to $100, or $1 growing to $105 in the case of REITs. So a little bit more than the overall stock market. However, a lot of people used to say, hey, invest in real estate because it doesn't go down in value much. And before 2006 or so, that was probably generally true. There wasn't a big time that I could remember back in the 20th century in which real estate fell tremendously in value. I think you'd have to go back to the Great Depression for that. But during the Great Financial Crisis, which was basically triggered by a bubble in real estate prices, which was triggered by a whole bunch of other factors. Basically, real estate investment trust and real estate investing generally fell very significantly, even a little bit more so than the S&P 500. So basically, real estate did turn out not to be a very good diversifier at that time. If you look at this chart, it breaks down REITs by sector, and the blue line is 2007, the red lines are 2008, the green is 2009. So you see in 2009, basically all REITs increased in value, rebounded significantly in price. Now remember, whenever you look at a chart like this, negatives are much more impactful than positives. when you get a minus 50% rate of return and you look and say, what does it take to break even? You have to have a 100% rate of return to break even. So those green lines, there was a rebound in 2009, towards the end of 2009, but it was not yet as significant in order to make up for all of that. You'll see that lodging and resort REITs, because people were basically not traveling because of the Great Recession at that time, did extremely poorly. Industrial REITs did poorly. Retail REITs, a lot of stores closed. Even offices, there turned out to be a lot more vacancies. Healthcare REITs pretty much held their own in this period of time. And healthcare REITs, you can actually break that down between uh, healthcare offices and hospitals, and you can also look at medical clinics, um, physical therapy offices, and then nursing homes. And nursing homes are kind of a distinct form of investing in healthcare. About 70% of all investment advisors recommend REITs to at least some of their clients. And most target date funds, if you were to invest inside a 401k and it has a fund that says this is one fund that is appropriate for you if you're going to retire in 2065, well, part of that fund, a small part of that fund, is going to be invested in REITs in some way. There are actually three types of REITs. There's equity REITs. Equity REITs means you're investing in real estate itself. Mortgage REITs, which invest primarily in mortgages. So they buy up a whole bunch of mortgages and they bundle them together. And then there's hybrid REITs or something in between. Now, most REITs are equity REITs, where you're actually investing in real estate itself. The number of mortgage REITs out there is not that significant, although it has increased in recent years because of a tax law change. The tax reform that occurred at the end of 2017 and was effective in 2018 basically says for certain shareholders of REITs that are held in taxable accounts, not IRA accounts, not 401k accounts. If you are at the top income tax rate, then you get to exclude 20% of dividends from certain businesses, including REITs, from that. So basically, if I owned a REIT and it generated, let's say, $1,000 of income for me, I could exclude from my income $200 and only have to report on my income tax return, at least for purposes of determining taxable income, $800 of that. That's a very significant tax advantage that happened. And as a result of that, basically the prices of REITs after that was enacted, during the process of its enactment and thereafter, the value of REIT shares rose because of this basically fairly good tax break for REITs. You can buy a diversified basket of REITs by buying basically low-cost index funds. So Vanguard's got a low-cost index fund that basically says, well, if you don't know what REIT to buy, if you don't want to guess which REIT is going to be the best managed, why don't you just basically go out and buy almost all of them? They have 184 publicly traded REITs in this mutual fund. The annual expense ratio is actually a fairly low 0.12%, and the 10-year returns as of the end of February of this year was 11.29%. Very healthy returns over the last decade or so. Another fund is the Dimensional Funds Advisors Real Estate Securities Portfolio. Basically the same thing. It's a mutual fund that owns a whole bunch of REITs, in this case a little bit less, 155. Dimensional excludes, for example, nursing home REITs and some other types of REITs. The annual expense ratio is a little bit higher, but they've performed 11.75%, which is a little bit more than 11.29%. So if we look at real estate as an asset class, it has a fairly low correlation with other asset classes. That's a good thing. However, it does have layers of fees and costs. If you're investing in a real estate investment trust, for example, like a hotel, well, you've got a lot of different fees and costs associated with that. First off, you've got the cost of running the hotel, the labor and the materials and all that you need to basically maintain that property. There's a management structure over that hotel property itself. And then the REIT has its own office where it's managing this portfolio of properties. So you have this office staff and the manager of that REIT that gets paid as well. So you have some layers of fees and costs there. Um, there's less loss of risky, less chance that you're going to lose a lot of money. Um, and my guess is that during basically the crisis that we've seen here it is February, or rather late March. The market is down probably somewhere around 35-40% from its highs in January at this point. The stock market is. My guess is that REITs have also declined, but they haven't declined as much. There are some additional tax filings if you own a REIT and a taxable account. You have to wait and get a K1, and sometimes those K1s don't come out very quickly. A lot of times you're waiting for those. Potentially lower taxes as a result, and due to depreciation, that also affects your taxation of the investments, at least in terms of until you sell your REIT shares or until the REITs sell underlying properties, because they basically pass through depreciation on you. The REITs could implode. For example, if you have a REIT that has too much debt and rental income goes way down, which it very well could. For example, this year, if a lot of businesses have to close uh, and go under because of the economic crisis we're seeing, um, if that were to happen, then basically the REIT might be forced to close and liquidate, and you could lose a lot of money in the result of that. So basically, you don't want REITs to have too much debt. It's nice to have some leverage, especially if they can borrow at low rates. It's well secured usually, but you don't want them to have too much uh, debt out there, so that if there is a downturn, they can still sustain making those debt payments. So this just kind of indicates what's called funds from operations. It's one of those terms. You don't need to know this term. I'm just pointing out that it's net income plus amortization and depreciation plus the gain from the sale of assets. So if you look at, just hypothetically, an ABC REIT, it's got $15 million of revenue. It's got some expenses to maintain the property and have insurance and real estate taxes. It's got a depreciation expense. It's got some general expenses like office expenses and the like. And so it's total expenses, and that leads to net operating income of $7,700,000. It also had a gain on the sale of property, and then it had some other non-recurring income or expenses. So its net income in this case, $7,825,000. But the funds from operations, you get to basically how much cash is being generated. You add back in that depreciation expense, and the result is that from a financial statement standpoint, sometimes you'll see a loss on the financial statement because of depreciation or losses from the sale of the property, but the cash flow that uh, REIT is generating and payable to the investors in the REIT can stay the same. So another type of real estate investing is basically to get together with a group of people and form a limited liability company. It's a private way of doing it. You'll see this in pretty much every community around the country. A lot of times you'll see doctors get together and pool their money together, go out and buy office complexes that they in turn lease. Here's an example of a private placement memorandum. It's very much like a prospectus, but it's only distributed to qualified investors. And in this case, then only offering $10 million at $50,000 per unit. So they don't want a huge amount of investors in this thing. And in fact, the fund, because of the restrictions on the way these private offerings work, in this case, they want no more than 95 limited partners. And here's another one. This is a $100 million fund. The minimum offering amount, in other words, what an investor would need to invest is $2 million. So this is a very large private offering of a limited liability company where they're seeking very wealthy investors from all over the country to invest in this thing. And uh, you can also invest not only in units but also into promissory notes issued by that. Are private limited liability companies a good investment? Well, if you're in business, if for example you have a store and other people have stores and you want to get together, or like doctors want to have offices together and the like, um, then you can. It's a really good way of putting all the money together and pooling to basically own a whole bunch of offices collectively. Um, What's nice about that is you can lessen your management fees rather than have a real big company where there's a management associated with maintaining all these properties. If you have an office complex that, for example, has got 10 or 15 or 20 offices in it, uh, it's possible that maybe there's a really good office manager, bookkeeper, who can basically handle the office management of that on a part-time basis, so you can hire someone at a fairly low cost to do most of the management for you. Of course, the doctors are going to probably meet on a quarterly or an annual basis and review the financial records and discuss anything as far as major maintenance or improvements to property and the like. So there's a little bit of hands-on in there. Uh, you have to be an accredited investor, which basically means, under the current definition, you have to have gross income of $200,000 a year. If you're married, it's $300,000, or a net worth exceeding $1 million. So, a lot of doctors will meet that definition, certainly on the income side, depending on what type of practice they have, and they will buy into basically these privately traded, private limited liability companies to do that with. Just a little note here, the SEC is likely to revise its definition of accredited investor sometime this year, and these figures on what is an accredited investor will likely change. What's the best way to own real estate? Not have any management fees at all. Basically, you do it, you manage it, you maintain it, and the like. I have actually seen this work. Usually, it's in the standpoint of couples, where, for example, one person is really good at handling tenants and screening tenants, like for an apartment complex, making sure that they do basically credit checks on them and really good at bookkeeping and the like. And the other person is very skilled at maintaining property, so you don't have to hire a lot of contractors to fix things all the time. So that tends to be a very hands-on type of thing. Um, but you can have some really good returns there because you're basically lowering your maintenance cost and you're lowering your management fees, but basically putting in your elbow grease yourself in there. The risks are greater with that. There could be a lack of diversification. You're only owning a few units as opposed to, let's say, 700 buildings all across the country or something like that. And the risk might also be geographic. For example, you might buy an apartment complex in an area of a city or a town, but that area over time declines in terms of its attractiveness for some reason. It's not doing maintained well, that whole area of the city, and as a result, the value of your real estate holdings go down. Of course, the opposite could happen. You could buy some real estate that is in a fairly low rent or rundown area of town, and then the town expands into it, and all of the rents go up and the like, and property values go up. So I have seen this work in some cases. It usually works with apartment complexes, or if you're getting into single family homes. The only way I've really seen that work is with a really small homes where the rents are like in the range of $500 to $700, and you really have to look at the real estate taxes in terms of making that work. Here in Kentucky, real estate taxes are not very hard, not very bad, but like a state of New York, real estate taxes are 4 times that amount, and you actually can't get enough from rents in a lot of areas of New York to help pay the real estate taxes, the maintenance cost, and the insurance, and it's make any kind of profit at all. All right, so now we'll turn to commodities as an asset class. Commodities, what are they? Well, mostly it's energy. It's crude oil, it's natural gas, and it's coal. Those are the biggest components of the commodities in terms of a dollar volume of what's traded. But you also have other types of commodities, precious metals, platinum, silver, and the like, aluminum, copper, iron, and steel. You also have food and consumer products, corn, rice, coffee, tobacco, sugar, orange juice, and you also have cotton, wool, timber, and rubber, and also cattle, feeder cattle, live cattle, and lean hogs. So those are just an example of the types of commodities that are out there. Why do we call them commodities? And the reason for that is, for the most part, let's say you own a barrel of Brent crude oil, which basically is oil that came from basically off of England. Right? If you own a barrel of oil, that oil can be combined with another barrel of Brent oil and stored in a big storage tank. Right? And when it comes time for you to get your barrel of oil, they just got to turn the spigot and give it to you. So basically, commodities, for the most part, are able to be combined, if your ownership with somebody else's ownership, and stored together, and basically mixed together, and because they're all basically the same thing. There are different commodity indexes out there. One of the biggest indexes, the longest standing index here, is something called the GSCI index. It's been around a long time. One of the criticisms of that index has always been that it's dominated by oil and natural gas and coal. So we have this other index. It's now a Bloomberg index, I believe. It's changed names over the years, where they basically cap how much you have in any one sector. So you have energy, you have grains as a much bigger part of that, livestock, precious metals, and the like. So that's a little bit more diversified in terms of the index itself. So if you're looking, for example, to invest in a commodity index fund, you have to be careful what index that you're actually tracking, because the components will be different. The risk and return of commodities, this is just one chart. It basically shows that commodities have a fairly high standard deviation and a fairly low return over the long term. Commodities, basically, if you read the Rick Ferry book, you would have seen that he doesn't like commodities as an asset class because, quite frankly, the rate of return for commodities doesn't really exceed that of inflation by a very large margin, but it's very volatile. So even though you can invest in commodities, basically the way that you do that is by options contracts, where you agree to accept, for example, a delivery of oil a year from now. You buy barrels of oil. When that, as the time approaches, or even on the day of that, you can still sell your futures contract to basically a refinery. So there's a very liquid market for that. So you can basically buy options to basically accept delivery of different types of commodities in the future, and you would sell them to basically people who actually use those commodities as the time for delivery of those commodities comes due. You don't actually have to worry about, hey, where is it being stored and all that. That's all handled through the contract mechanism there. Or you just go out and buy an index fund that basically owns future contracts and the like. However, commodities that's back in the 1970s actually did pretty well, and the reason for that is oil prices used to be at extraordinarily low. I mean, I remember paying gas back for like 12 cents a gallon and things like that. But in the 1970s, we had two big oil shocks. And OPEC basically limited the amount of oil that was being pumped. It led to some gas shortages twice in that decade, and oil prices went up significantly, as did other commodity prices. And so commodities basically outperformed the stocks in that time period. Since then, commodities haven't done extremely well. They did go up quite a bit in value in the first part of the 21st century, but when the great financial crisis came along, they went down significantly, and part of that is because oil had reached $150 a barrel. Uh, by comparison purposes, at the start of this year, oil was trading around $50 to $60 a barrel, and as of right now, oil is trading below $30 a barrel. Here we are at basically the start of another recession, in essence, caused by the coronavirus. But also, there has been a breakdown in terms of OPEC. Saudi Arabia has said we're going to pump as much oil as we want. Uh, Part of that is because of Russia basically not agreeing to limit production. So there's some strategy going on in the oil markets and the like right now that has really driven down the price of oil. So uh, basically, what we see is really fairly lousy returns in commodities um, over the last 10 years or so. So are commodities a good investment? Um, Roger Gibson, who wrote the book on asset allocation, really likes commodities for use in their portfolios because over the very long term, they actually have a different correlation to stocks and to bonds. Um, it can be either extremely low correlation or negative correlation, but that's again, it's not always the case. That low correlation didn't work back in 2008. They do have very high volatility, and over the very long term, low expected returns. I think another reason I'm personally suspect of commodities as an investment is basically there's a substitution process that goes on. For example, oil. Um, if we look at that 30 years from now, there probably won't be a lot of oil being pumped. Um, we're always seeing a decline in coal production. Natural gas production will probably continue for a while, but even that might stall as we shift towards renewable energy. A lot of the precious metals, like lithium, for example, that's used in a lot of car batteries, there's a lot of new developments going on there where they're finding basically ways of using lower cost metals than these high cost metals, high cost in terms of both their the cost to produce them, but also the fact that they're relatively rare. There's only a few places in the world that you can find some of these metals, and that tends to drive up the prices, especially when demand goes up, but the supply hasn't adjusted yet. So you have some alternatives coming into play, and for that reason, I'm not a big fan of commodities for that reason as well. You already have some exposure to commodities just by owning stock. For example, you're going to own a mining company that mines different metals. You're going to own ExxonMobil stock as part of an index fund. So you already have exposure to some degree to commodities, for example. Um, and as we've seen, they're not a perfect hedge against stock market downturns, certainly not back in 2007 to 2009. However, a lot of investment advisors do believe in commodities, that they should be part of an investor's portfolio, and they make the portfolio more efficient um, in that regard. Modern portfolio theory might suggest that they be part of a portfolio, but again, because of their low long term rate of return and high degree of volatility, I'm not a big fan of them. So let's discuss hedge funds. Wow, here's something entering Greenwich speed limit 2% and 20%. All right, we'll come back to that joke. Greenwich, Connecticut is basically a home to a lot of hedge fund managers who live in that area and who have offices in that area. A lot of the hedge funds here in the United States are based in the New York City area, and there seems to be a concentration around Greenwich, Connecticut in particular. There are actually different types of hedge funds. There are five main types of strategies. You don't need to know these strategies, but basically, long short strategies are basically actually hedging strategies. The original hedge funds actually hedged against market downturns. But there are other types of strategies, everything from, for example, there are funds that invest in companies that are uh, have just gone into bankruptcy. So they want to buy up the shares of stock and look for the liquidation of that company to make a return, for example. Um, there's all different types of strategies out there. Um, so let's compare hedge funds versus mutual funds. Well, mutual funds are registered with the SEC. Hedge funds are not. They are private investment vehicles. Investors in mutual funds can put in very small dollar amounts, typically even as low as $1,000 to invest in a mutual fund, or an exchange traded fund even less than that. Hedge funds, typically the minimum investment is $1 million or up, so these are basically accredited investors that invest in them. Mutual funds have an unlimited number of investors. You can have thousands or millions of investors in a mutual fund. Hedge funds, there's a maximum of 499 limited partners there. Hedge funds, one of the things, because they're not very carefully um, regulated and overseen and inspected very well, mutual funds, for example, all of the assets at that mutual fund have to be held at an independent custodian for the most part. But hedge funds, that's not the case. And they're not, because they're not inspected, you'll see hedge fund managers actually take off with the cash sometimes. And for example, this particular hedge fund manager, Bayou Hedge Fund Group, uh, he faked his death to avoid prison time. He left his SUV abandoned on a bridge with the words "Suicide is painless" written on the dust of the windshield. Authorities never presumed him dead and continued the search. The loss at his hedge fund was estimated at $350 million, the amount that investors lost or so. And in fact, he was eventually caught and put in jail. Another big scandal involving another hedge fund that basically the managers took some money was SAC Capital and the like. So a little cartoon here, it says, well, this is all that's left of the hedge fund. Yeah, that could very well be the case. Because they're not very closely regulated, uh, people can take off with the money. It makes it very difficult if you're an investment advisor to do diligence on a hedge fund. Due diligence is the term I'm using, because how do you go and basically verify that the assets are in fact there without actually going physically to the office and looking at statements and the like? And even then, sometimes things could be falsified. The biggest hedge funds here in the United States, the biggest one is Bridgewater Associates. It's based out of Connecticut. No surprise there. AQR Capital Management, something called the Man Group, Renaissance Technologies, J.P. Morgan, one of the big broker-dealer firms, has an asset management division. They put together a lot of hedge funds, and there's others as well. The big problem with hedge funds is probably the fees. There's something called 2 and 20. Remember that from the very first cartoon? That means that there's a management fee that's paid to the manager of the hedge fund, 2% of the value of the assets of that fund every year. Compare that with a low cost index fund where you might be paying 10 basis points, not 200 basis points. Um, or 0.1% compared to 2%. But on top of that, there's a performance fee, also called an incentive fee. So if the mutual fund goes up in value, the manager can get 20% of that gain as well. That's the way that most hedge funds are structured, in some way like that. So if the hedge fund goes down in value, the manager still gets the 2%, but there's no incentive fee, and the manager does not have to get any money back. So even in the down market, the hedge fund manager is going to make 2%. Now that those fees have been dropping on average over time. This is a chart that shows from 2008 to 2016. Basically, the performance fee fell at 17.6%. The management fee fell from 2 to 1.5%. And some updated data there from a recent article. North American hedge funds, the performance fee has dropped to just under 15% uh, of the gains in the portfolio, and the average management fees have declined to 1.38%. This little young boy, who's the son of a hedge fund manager, says, the kids at school keep picking on me because dad's flagship fund didn't even beat the S&P 500 this year. They start calling me levered beta boy. And his mother says, sweetie, all you need to know is what matters is assets under management, the amount of assets that that hedge fund owns. Because your father funds brings in over $100 million in management fees alone. Yeah, If you're an active mutual fund manager, you do really good, you make good contacts with investors and the like. A lot of those active mutual fund managers will then go out and start their own hedge fund. They'll attract some of these high net worth investors who have said, hey, this is someone who's done really good in the past and can pick stocks or implement some type of investment strategy really well. And and they'll run a hedge fund typically for just a few years. They'll make a whole bunch of money when they do that, and then they'll go and retire. Uh, and whether they make money or don't make money for their investors is really beside the point. Warren Buffett made a very famous offer. He offered to wage 500,000 and no investment pro could select a set of 5 hedge funds, all right, that would over an extended period of time match the performance of the unmanaged S&P 500 index, which of course an index fund typically can charge really low fees. And he named the Vanguard S&P 500 index fund, which is very low fees, as basically his choice. And he basically bet, and somebody took him up on it. Protege Partners LLC put him up on that, and they each put in money to make that bet. The stakes were there, and basically the money would eventually go to charity, and there was the actual bet itself in terms of the language that we used over a 10-year period commencing on January 1st, 2008 and ending on December 31st, 2017. The S&P 500 will outperform a portfolio of hedge funds when performance is measured on a basis net of fees, costs, and expenses. Well, one of the things you should know here, January 1st, 2008, that was right before the stock market fell off the cliff. 2008 and into early 2009. So this is like probably the best time ever to be a hedge fund manager, because one of the big attributes of hedge funds is they say we do a lot better when the market goes down. And in fact, there were 5 different funds chosen, and in 2008, all the way to the right, the S&P 500 index fund went down 37%. All of the hedge funds that were chosen by the person on the other side did better than that. Still had down, but did not go down as much. But by the end, over that entire 10-year period, the S&P 500 index fund was up 85%, and none of the hedge funds, not one of them, beat the S&P 500 index fund. Only one of them even came even remotely close at 63%. Look at the very low returns for the rest. So yes, Warren Buffett had his trophy, had won the bet, and his charity was able to secure a nice little reward as a result of that. So one of the questions is, how did hedge funds get to be so attractive? Well, very early on in the hedge fund universe, probably way back in the 1970s, hedge funds seemed to do better. But there was actually a very limited number of hedge funds at the time, and they were using some investment strategies in a market that was not really going up much at the time. So it's possible that the investment strategies that they were using had not been duplicated by a lot of investors, and in fact, as a result, they did really well. But as more and more people started forming hedge funds, and we had more and more out there, then the advantages of those strategies basically may have disappeared. So that might be one of the reasons for the fact that hedge funds, which at one point did do very well, seem to have done a lot worse more recently. Cliff Asness, one of the investment researchers and speakers out there that I follow very closely, wrote in 2018, the reason to worry about hedge funds, because they had been underperforming the stock market, is decidedly and emphatically not that they failed to keep up with the stock market over this 9-year bull market at the time. The reason to worry is the evidence that there are correlations to traditional active stock picking. In other words, hedge funds have basically become actively managed stock funds, picking stocks and the like. Hedge funds are no longer what they once were, which was basically using different types of investment strategies to actually hedge against the market or do other things. And given that traditional active stock picking is such a consistent long-term disappointment, and we'll be studying that soon. He said, this ain't good. Yeah. In fact, the hedge fund industry has had closings for more hedge funds have closed than have opened for 5 years straight now. The biggest hedge fund out there is run by Ray Dalio. You may have read his book Principles, which is a fantastic book to read. Uh, he basically article published just a couple of days ago saying he didn't know how to navigate the coronavirus stock market sell-off. He should have cut all risk. And basically, Bloomberg reported that his fund had lost 20% at one point this year, whereas in comparison, the S&P 500 index was down 16% in the first 3 months of the year, as of the date that they surveyed this. Now that doesn't mean that all hedge funds did poorly. In fact, I think probably there are some hedge funds that did really well. Morgan Stanley looked at this just today. An article came out and basically said that hedge funds across all strategies were down an average of 7.6% worldwide, compared to a decline in a Morgan Stanley Capital Investments World Index of stocks of around 20% at the time. Um, so you would expect hedge funds, because they're using different strategies that are not always investing so much in publicly traded stocks, to when the stock market goes way down, to not uh, be as exposed to stocks as they are, and perhaps do a little bit better. Bridgewater again had lost about 20% year to date, which is matching basically the world index. But this other hedge fund called Saba Capital Management reported a 33% gain in March, bringing its year to date gains to 67%, which is pretty amazing. Uh, so, what did you learn about hedge funds today? I hope that you learned this. One is 2 and 20. What is 2 and 20? 2% management fee, 20% performance fees, and because of those fees primarily, more than any other thing, hedge funds are going to underperform. What else did you learn? Just say no. Don't invest in hedge funds. All right, that's the end of this tape, and look forward to you working on your class preparation assignment. Thank you.